Waste Management stock, ticker symbol WM, reported earnings after the bell and the stock was flat. However, it did see gains of up to 2%. And we're going to talk about Waste Management. What are the earnings? Is it good? And is Waste Management stock a buy right now? Guys, but before we dive in, if you could please go ahead, like and subscribe. It really helps me out. Let's dive in. So you probably know what Waste Management does, but if you don't, it collects, transports, and disposes of residential, commercial, and industrial waste across North America. They also operate recycling facilities, landfills, and convert landfill gas into renewable energy. Increasingly, they offer sustainability services to help businesses reduce waste and emissions. And the earnings were a beat across the board, beating on revenue estimates and EPS. Revenue actually grew 19.1%, largely in part due to their health solutions acquisition. And you can see right here, because of that acquisition, EPS only grew 6.5%. And this just has to do with the integration of the overall business. Now, gross margins did increase ever so slightly from 39 to 40.2%, so slight gross margin increase. That's a real positive thing. Net income margin fell, but nominal dollars increased to $726 million. But free cash flow margins were actually huge, growing 3.6% or 360 basis points. And this is supposed to be free cash flow, not a beta right here. And then free cash flow totaling $813 million. So the company really ramping up that free cash flow and gross margins, possibly shows some pricing power that they're still able to maintain. However, the company's balance sheet is something I've never really liked. Or $24.1 billion in debt versus $400 million in cash. So revenues grew 19.1%. You could see right here that operating expenses were actually up 20.1%. However, the big kicker was that interest expense or their debt service was up 70% from $136 million in the quarter to $232 million. And that goes to that massive balance sheet and that servicing of that debt. And that is why we actually saw net income up 6.9%. It really goes to show that a company with a very levered balance sheet that can really detract from returns looking ahead. Now, this is what their debt is structured like. So the majority of their debt is just senior notes maturing through 2054, interest rates ranging from 0.75% to 7.75%, a weighted average interest rate of 4.2% as of December 31st, 2024. So they do have a really good deal here. I mean, if any consumer was to go out and get a loan, let's say a business loan, they'll be paying about 7%, 8% on that loan. Waste Management were able to get 4.2%. Right, mortgages are 6.7% at the moment. So this is a good deal, but that is a lot of debt that they do have. They have a commercial paper program here with debt values ranging between 4.7 and 5.6%. They have a couple of Canadian senior notes for their Canadian division with a 2.6% interest rate. That's very interesting. And then they do have some tax exempt bonds maturing through this time with a weighted average interest rate of 3.7%. So they got some great terms on their debt, but it's just a lot of debt if you ask me, and it really does impact the valuation. We'll talk about that. Now, going back to the business and their revenue segments, they have two segments. They have this legacy business, right? That's their, trash pickup, trash disposal, landfill business. And they got their healthcare solutions, which is essentially disposing of toxic or hazardous waste materials from like hospitals. They recently acquired this business. And so, they're only just starting to see the revenues come in, and there's still a little bit of integration risk. That is why we're seeing net income where it is SG&A a little higher than it should be. However, once fully integrated, which they say the healthcare solutions business will be fully integrated by Q4, you should see margins expand. Nonetheless, this is part of the reason why we saw revenues grow 19%. So it is artificial, but this is going to be the biggest growth factor here because this healthcare solutions is growing at a double-digit clip, whereas this legacy business is growing sort of at that mid-single-digit pace, as you can see. However, and this growth right here was driven by price increases of 6.4% as well as a disposable yield of 4.1%. So increasing volume, which is really healthy. And this is the type of business you're going to get when it comes to waste management. It's just a business that's consistently going to grow, very defensive, very predictable streams of revenue. Now, looking ahead, part of the reason why the stock was up 2% after the release of its earnings, the company did pare back some of its gains, but the reason being had to do with this right here. Free cash flow is now projected to be between 2.8 and 2.9 billion, an increase of 125 million from the company's initial guidance. The increase in free cash flow outlook is driven by recently enacted tax policy that restores bonus depreciation to 100%. That is a policy that Trump implemented in the Big Beautiful Bill. So we are starting to see the flow-on effects from the Big Beautiful Bill, that spending package, and we actually got a free cash flow guidance raise. Now the total, and this is absolutely good, absolutely solid to see that. This depreciation, this bonus depreciation is actually going to impact the free cash flow lines of all these businesses. And I think that is ultimately what can drive prices higher throughout Q3, Q4 into 2026. Carrying on here, total company revenue is now expected to be between 25.2 and 25.4 billion. The decrease from prior expectations is primarily related to the recent decline in recycled commodity prices, which has had an outsized impact on the company's lower margin recycling brokerage business, as well as the impacts of a decline in collection and disposable volumes in the first quarter of 2025 due to a particularly harsh winter weather. Adjusted operating EBITDA margin is now expected to be between 29.6 and 29.9, an increase from the prior guidance between 29.2 and 29.7. That's very solid right there. And then the company did say, we set a high bar in 2025, and through the first half of the year, we have met those high expectations. Our team is focused on serving our customers, optimizing our costs, and innovating to support differentiation in growth. Executing on those priorities is expected to drive strong results in the back half of 2025 and position us to deliver our guidance, achieve attractive returns on investment, and grow shareholder value. Now, waste management is not a cheap business for the growth profile. Trades at an EV to EBITDA of 15 times. That's pretty pricey considering its growth profile and its margin profile. Stocks of this magnitude would trade closer to 11, maybe 12 times EV to EBITDA, and a PE ratio of 29 times. Again, the companies at this rate would probably trade closer to like 17, 18 times. So it is an expensive company and it has a negative shareholder yield. However, the truth of the matter is waste management is a defensive stock, very predictable revenues, strong track record of execution. And when we look at our valuation model, right, we plug in $23.9 billion in revenue, growing at about 8% through 2029, driven by the healthcare solutions segment. And then we've seen the adjusted EBITDA margin of 31%, right? So that's what we're penciling into 2029. So we're looking for very solid growth as well as some margin expansion. You get EBITDA of $11 billion. And we are seeing minor multiple contraction to a 15 multiple. And then we get the enterprise value, subtract the net debt, which is a lot, $24 billion in debt. You then get the equity value and then divide by shares outstanding, which is decreasing by 0.5% sequentially. You get a 2029 stock price of 359. The current stock price is 2.27. That gives you an 11% compounded annual return with a 1.45% dividend yield. My fair value is $204 per share. The company trades at 227. So a little bit overvalued, but it's very hard to find a company like Waste Management actually be undervalued because all the stock does is just trade to the upside. This is the technical chart. And you can see the stock had a massive rally here at the end of 2024 into 2025. And it's sort of trading in this massive sort of like wedge. We're at the bottom end of the wedge right here. And I would say that it's probably time to go ahead and trade up, especially given these earnings. These are great earnings from Waste Management, and likely the stock's going to go ahead and tackle those all-time highs before the end of the year, very close to the 250 area. A stock like this, after these earnings, seeing a double beat and a raise, especially on the free cash flow level, you probably will see the stock trade higher for another quarter. Looking at what analysts expect, you're looking at the high-end range of 227. The average price target is 252. That's near the all-time highs. That's the current stock price. And you could see at the lower end, the street is expecting $195 in earnings per share. So the reward, not super great right here. I prefer, stocks where you see like the minimum price target, the lower end is pretty much where the stock is. That means minimal downside. Nonetheless, a very defensive stock, great earnings. They beat expectations. And I do think this trades higher to all-time highs in the foreseeable future. But guys, if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.